So look, if you're new to investing, and by that I mean you've been investing less than 10 years and not sat through the last recession, then I guarantee you I would bet my last bottom dollar that you have made this mistake. And I'd also bet that majority of people watching this video, if they look at their investing portfolio, are probably doing this same mistake right now. Unfortunately, I have seen even the experienced traders here on YouTube continue to do this mistake, and as it becomes much more easy for the average person to open a brokerage account and YOLO in with leverage into AMC, this mistake is becoming more and more apparent. And the way I see it, people will continue making this mistake time after time, and it has to stop. You are not special. You are not the next Warren Buffett. The stock is not the exception to the rule, and God forbid, don't be thinking this time it's different. In this video, I'm going to talk about the biggest mistake investors are making right now, and I'm not just talking about new investors, I'm also talking about people who've been investing for near enough 10 years. People who've not sat through the last recession and experienced what real pain is. So hopefully you take some of this away and then you can go and readjust your investing lifestyle, because again, I guarantee majority of people are still making this mistake, including me. And look, let's kick this off with something very basic, something we all forget to do from time to time, and something that if not done correctly can literally cost you a hell of a lot. We need to honor the stock market gods and make sure that like button is turned blue for the YouTube algorithm. Now look, jokes aside, whether you're investing $100 or $100,000, I can guarantee you we've all done this at some point. And like I said, I'm going to give you an example of something I've done in the last year, which really I sort of regret doing, but a way I sort of managed the problem. And it's something that even I fell into. And I'm also sure every seasoned investor will tell you they've done the same thing at some point. But the reason why this is so important is the fact that people right now are making a lot of money on this mistake. And it's going to work, and it's going to work, and then it's just going to not work, and you're going to lose everything. And again, go back to what I said earlier. You're not the next Warren Buffett. If you're watching this video, you're probably not a seasoned investor, and you probably haven't built up the risk appetite and risk tolerance yet to manage your account successfully. And I'm sorry to give you the reality check, but I'm not the person here who's going to just pump up a stock and say you should buy the next Tesla, because look what happened to Nikola. Look what happened to the other EV companies like Lordstown that have just fell away. That's not what this channel is about. I'm going to give you the cold hard facts, and hopefully someone, just one person, that's all I'm asking for, take this on board and apply it to their investing strategy. So what is this massive mistake? It might sound really simple, but bear with me because I'm going to give you some live examples, including the one I messed up on just a few months back, and that is mistaking value for hype. And this might sound absolutely crazy to say, but right now I see every second YouTube channel is a value investing account, and they're all into something like NIO or Tesla or Palantir or God forbid AMC and GameStop. They are not value investors, it's complete speculation. But you can even come down as far as saying companies like Apple and Amazon also are not value buys. I'm sorry to say it, they're just not. So what do I mean by this? What do I mean when something is value versus something is hype or speculation? And it's not saying that these hype and speculation stocks are bad, because, I mean, for example, I currently hold Amazon, but I wouldn't call it a value buy. I wouldn't call it a value buy right now. I'd call it more of a speculation trade. More of it that I think Amazon will continue growing up because there's a lot of new investors in the market and people want to go into cash-rich companies. I don't think Amazon's got that much growth, and I know it has. That might sound really bad. Let me take that back. But I think that Amazon has a lot of growth priced into it, thus meaning it's probably not as good value and there might be better plays out there. And if you're not following along on how to differentiate, let me give you a live example. Let's say a stock is up, I don't know, 1,000% in the last 18 months. And just for example purposes, let's call this stock NIO. Ticker symbol NIO. Look at that, up 1,000% in 18 months, and people still think this is good value. Now look, if you bought NIO at the current price to make money, that's absolutely fine, but God forbid calling this a value investment. Let's say you bought NIO because you know electrical vehicles are the future. This is one of the biggest EV companies out there right now. In China, one of the biggest countries that are using EVs, and you know this sector is gonna grow huge in the past. You've seen what's happened to Tesla, and you want to be on the board of the next Tesla. Great, that's fantastic, but none of that is value. All of that is speculation. It's got nothing to do with value and the fundamentals of the company. I mean, what would good value be? Well, it would be something that is undervalued in terms of earnings, for example. It would mean that it's got a good price to earnings ratio. That means their profit margins are quite good and they're expected to grow phenomenally in the future. Another way of determining good value would be that it is undervalued in terms of its competitors, and I'll come onto that in just a second. Another way of determining good value might show steady growth in terms of cash flow and revenue, and NIO is doing this, but I'll come onto in a second how much of this growth is priced into the stock. After all, it's up 1000% in 18 months. And another way of determining good value could be that you see a company in a growing sector that hasn't really grew yet. And if you want an example of that in this sector, you can just look at like Ford, GM, and companies of the sort who didn't really go up initially with the EV craze, but as they've come into the market, I mean, these companies year on year have done fantastically well. That would mean that way back when I said GM and Ford were probably good value if you wanted to buy an EV stock, well, yeah, turns out I was right. And look, I know I'm bashing NIO a bit in this video, but if you want me to do a full analysis of NIO, drop the comment below, do NIO in the comments, and I'll give it a full review and my final thoughts and thesis, because I'm definitely not saying that this is not a buy, I'm just saying it's not good value. And what I'm getting at here is NIO has a lot of growth priced into the stock. If you want to be a value investor, you need to buy the stock at a valuable price. This is by far the biggest thing in value investing. And if you are a member of our WhatsApp group or our chat room and you see my buys and sells, you should be understanding this now, because I won't just size into a stock, and I'll get on to how I size it in just a second, but I'll buy in little bits all the way down because I know what average price I want to get on any investment. I don't just go and buy Amazon or buy NIO today because I think it's going to go up tomorrow. No, that's not value investing. Think about it this way: the current value of a stock, the current market price of the stock, represents what investors are willing to pay, and it should represent all future revenues and cash flows this company could generate, because stocks are forward looking. You're buying an investment to see what it does in the future, not what it's valued at today. And right now, how much of the future is valued into NIO, as this example dictates, because right now BMW, Volvo produce way more EVs and have a lower market cap. So if you think NIO is value, then so is BMW and Volvo, and you should be buying them as well. Now, I know there's going to be loads of keyboard warriors destroying that dislike button because they cannot take criticism and will completely disagree with me, and that's fine. They're going to be down in the comments.
NIO's a tech company, it has driverless functions and all that crap.
And look, if that's you, grow up. NIO sells cars. Most of its profit comes from cars. Tesla's the exact same, and they are not the only people looking at driverless technology. Look, I have a BMW which has an electrical capability. It's like a hybrid, it's a 530e if someone's into cars. Not really that into cars personally, but I mean, it pretty much drives itself on a motorway and I can get a snooze on the highway. But I'm saying BMW, other companies are also investing into driverless technology. Someone might have better tech, someone might have worse, but my point here is the market share will be dwindling down fast. Now let's move away from bashing NIO, because I know I've sort of gone on about it, but it's quite a big thing. I mean, you can even apply this to my recent trade in SRAC. Now, SRAC was a SPAC. It was going to merge with Momentous, which had the long-term plans of mining asteroids. Now, if you are a long-term subscriber, you will know, and if you're not, by the way, please do subscribe and turn on the bell, but you will know that I love my space stocks. I think this sector is going to be huge, and the mining asteroids thing just got into my head, and I jumped in. But luckily, I am a quite experienced trader, so I didn't go in with my full account. I went in with really small size, very early on, very low, and as the stock price rocketed up, I didn't buy any more because I thought it was going to go higher. I had my value entry and I just waited, and now guess what? The stock came all the way back down. I only sold a little bit for profit, and I'm pretty much break even on the trade as a whole. But in this example, I didn't really use as much rationale. I wanted to just sort of jump in because I knew this could have huge potential, and it did. I actually was up like 200% at one point, and I should have took a lot more off the table. That's my mistake. But I did mistake value for something else. hype. And I made that mistake, and I guarantee you I will remember it going forward. But look, it's very easy on YouTube and on Reddit to follow the hype and follow the dreams just because somebody who sounds like they know what they're talking about is saying something is good value because it has huge potential. Look at AMC. I see people on Reddit, and this is genuinely infuriating to me. I see people saying AMC is good value right now. No, it's bloody not. There's people who bought it thinking it was good value and are down 20%, and they're trapped. People are thinking that because the cinemas are opening, Christmas movies are going to come out soon, and things like that, they're going to sell mega amounts of popcorn to make profit. They think that AMC is good value. No, that value is already priced in and some. AMC is a bag of shit company. It is really overvalued. It does not have good revenues, and it has a shit ton of debt. This is not a good value buy. It's near enough at its all-time highs, especially if you just take out the recent pump. It needs to dilute and it needs to raise cash. So yes, I am very passionate. AMC is not a value buy, and to say that is completely idiotic.
How dare you?
But I remember people saying AMC on this date in May is going to go to the moon. Then there was a share recount in the beginning of June. Then there was a share recount in the end of June. Then there was something else in July. And I mean, we're all still waiting. At this point, Santa's going to be delivering out free chat room subscriptions before this even gets anywhere near to the moon. And on that as well, if you want to join our chat room for free, sign up with eToro on the pinned comment, deposit, make a trade, and you get lifetime access. So how the hell do you fix this? Well, there's two real ways you can do it. And if you've made it this far in the video, first thing, thank you for bearing with me. But these two things, I think, can genuinely save you a lot of heartache, and more important than that, make you a much better value investor. The first thing is quite simple. It's scaling in. It's something that I talk about time after time. If I see a company that I really want and I just need to buy it, Alibaba is an example. I don't buy in with my full size. If I'm going to allocate $1,000 to this company, as an example, then I will buy $100 slots every time the stock falls 5, 10, 20%, something along them lines. The lower it gets, the more I buy. This is what options are for, really, if you look at it. I mean, but that's the key point here. Size in slowly and scale in. And that way, when it's in your portfolio and you see it's losing money or you see it going up, you're looking at it every day. You will be looking at news, you'll be doing your due diligence more because you have skin in the game. But the key thing with this point is, because you're scaling in, you haven't thrown in that $1,000, you've only got $100 in the game, it falls 10%. You got it wrong. It's easy to admit you're wrong when you've lost 10 bucks. If you've lost $100, well, that's a different story, isn't it? And the second thing, and probably the biggest bit of advice I could give any investor, not just on this subject, but every single investment, is be objective. Be as objective as you can. I don't know about you watching this at home, but definitely I worked hard for all of my money, assets, and investments. I'm not going to just give some geezers who run a board on a random company my money and say, look, do what you can with it. I've never met these guys. I've never met them, and I probably never will. So why should I trust them to make me money? They give me a balance sheet, some news, some bullshit. Why should I trust them? And that's why I've got to use every single bit of research into the filings, into the valuations, to make sure I make the best decision. These guys don't care about us. The guys who are running the boards of companies, don't ever let them. Their job is to make money from that company. They don't care about you investing, because I promise you, in their eyes, they don't give a shit about you. They really don't. All they see you as is a way to raise capital, and if they can dilute you when they need to, happy damn days. So the way they see it is you're in a way a bit of a leech. And that's the way I look at every company, and it might sound really harsh, but that's the way you need to do it. Your money you've worked hard for. I always look back to my first job. I was 14 years old, glass collecting in a nightclub, and it was pretty cool. You know, I lied about my age, but I was going to school and I was the kid who had access to a cool nightclub. And some of the stuff I seen at 14, well, it made me a man a lot quicker than the military did. But the point there was I was earning like maybe 30, 40, sometimes 50 pounds a day. Okay, not a lot of money. I was working like 11 hours some days at the age of 14, and it was definitely taking its toll. I did it for 2 years, and whenever I make an investment, I always try and remember this. I always try and think, how many nights would I have to work if I lost this money? And in that mindset. Now, of course, I've done a lot more with my life since then, and I'm not saying there's anything wrong against glass collecting, but I try and remember how much I earned then. And I think that you should too. If you throw in $1,000 into any investment, how many days do you need to work if this goes tits up? And if you have that mindset of protecting your capital before any looking at returns, you will do a lot better. You should be very protective and subjective with any investment. Don't just YOLO into Rolls Royce because I told you. I'm just a guy on the internet with a beard. You're absolutely crazy and you need to do your own due diligence and be very subjective with it. So look, I hope somebody is still watching this far and a code word is coming, don't you worry. But it is absolutely paramount that you be very careful and don't confuse hype with value investing. I mean, look at it this way. I remember Tesla running and everyone looking for the next Tesla and Nikola, Lordstown Motors, and the list goes on with EVs, to be honest. We then seen it with the short squeezes. Before that, we've seen it with the weed sector. Before that, it was the Bitcoin. There's always this sector momentum that does eventually die off when the next sector pops up. So just don't get caught. Be sure to do your own due diligence and you should be fine. There's no such thing as being too cautious when you're doing your research, and you should be protecting your wealth before you're looking at making any gains. Now, just a quick one before we get to the code word. If you check out Patreon down in the description, we have a WhatsApp group, a chat room. There is some discounts on there right now, but when they're gone, they're gone. So if you're interested in signing up, go and check out Patreon down in the description. The code word for this video is I buy value, and I'm curious to see how many people drop that down in the comments because this is, again, a long-winded video. That's it from me. Smash the like on your way out, and I'll see you in the next one. Take care. Peace.